Good morning and welcome back from your break. My name is Navin Lala. I'm from the Structured Solutions team and I'll be discussing managing longevity risk, presenting with my colleague Chris Siriram. So, like investing, there isn't a silver bullet to managing longevity risk. So what we seek to do is just to give you an idea of how we're thinking about longevity risk and the investment strategies we're doing in response to managing longevity risk. So I know that I'm speaking to a very seasoned institutional audience where we're well versed with retirement saving challenges, but I thought it was important to frame the problem just to help our discussion. So if you look at the current assessment, looking at the Alexander Forbes Manager Member Watch Survey, less than 10% of savers will accumulate enough savings for retirement. Add to that the complexity of South Africa's very own socioeconomic dynamics. For example, for every salary, you have a multitude of beneficiaries being funded from that. It could be parents, siblings, relatives, etc. So it leaves very little room for discretionary savings. If you think about the target rate for replacement ratios, the industry's gold standard is about 75%. So if you only got about 6% of members that are likely to retire with a 75% replacement ratio, it's quite a dire situation. And thinking that more than half of members will only reach a replacement ratio of 20%. So add to that, if you look at the ALSI, we've had this great flat from 2014 till pre-COVID. So members that were, let's just say, in their mid to late 40s, they'd missed 6 or 7 years of equity returns. And now that we're in this reflation trade of synchronized global growth, these members, based on their life stage or life cycle regime, they'd be moving into cash or interest-bearing assets at a time when we're at record low rates for short rates. So that's quite a dilemma, and add to that an additional layer of life expectancy. So if you look at the chart of life expectancy in the 1950s, South Africa had a life expectancy of about 47 years, below the average of 50 years or 46 years. You've had India at 35, the US at 68, China at 43. So those were extremely low in the 1950s. Fast forward that 65 years, life expectancy in South Africa has increased to 62 years. 68 in India, 79 in the US, and 84 in Japan. So there's been a vast improvement in life expectancy. So research suggests that during pre-modern times, life expectancy around the world was around 30 years. And as you had in the industrialization of nations, you've had advances in healthcare, technology, etc., and that increased life expectancy. Where since the 1900s, life expectancy has virtually doubled to 70 years. And if you think about living longer, how's this for a stat? For those born after 2014, they have more than a 50% chance of living beyond 100. So if you look at the life expectancy chart of South Africa versus the world, South Africa was on trend from 1950 till about 1990. And then the HIV/AIDS pandemic hit South Africa and devastated life expectancy from over 60 years to just below 55 years. So in the space of a decade, our life expectancy went backwards by about over 30 years. With the effective rollout of South Africa's antiretroviral program, South Africa's recovered and we're back to trend. And that trend is looking very much in line with the rest of the world. So what does that mean for retirees? It means living for longer means your retirement savings need to last you for longer And with South Africa not having enough retirement savings, it means that because we're living for longer, we either need to take lesser income to cater to compensate for the extra years of living longer, or we need to extend our retirement age, means working for longer, which is also quite challenging because if you think of our group at First Rand, retirement age is 60. And I think that was revised down from 65 years, maybe in the last 5 or 7 years. And that's a function of the various schools of thought looking at productivity and efficiency, where beyond, I think it's mid-50s, productivity starts to decline. So I think that's quite a dilemma for companies and not an obvious choice or decision to extend the retirement age. So investors can, like I said, extend their retirement age, increase their savings, or buy guaranteed annuities. So one of the realities of living for longer means more time. And I think we're all very familiar with the benefit of, or the marvel of compound interest. And we all know the benefits of saving earlier. So if you look at this illustration on the chart, you got Jack who's started saving way before Blake. And you can see the massive gains made in savings. Similarly, saving for longer also gives one the benefit. So we're cognizant that equities are one of your strongest hedges against inflation and real returns. However, we're also acutely aware that equities have the most risk relative to the traditional asset classes. And we don't want to risk or put any capital at risk, especially during the intermediate stages of one's retirement investing career. So the opportunity at hand, the way we see it, is investing in protected equity. So we want to harvest the equity return, but without the risk of capital loss. So for an example, if you examine the top part of the chart, we've taken a retirement pool as an illustration of 20 million rand. We've said on a cohort of 5 years, 10 years, 15, 20, 25, etc., what is the maximum income on an inflation-adjusted basis that a member would get post-retirement before running out of money? So that is, the inflation pot goes to zero. So in the top chart, you'd see that a 4 million income per annum would last you 5 years. And a 2 million odd income would last you about 15 years. If you compare that to the bottom chart, you can see that those lines that come down have moved far to the right. And what that's saying is by investing in protected equity rather than in interest bearing, you gain additional years of income. If you examine this table, you'd look at the top line, it gives you the years to retirement or years after retirement, and the first row is saying annual income derived from protected equity. And that you can contrast that to income derived from cash. So you can see it's given you a significant difference by the percentage overall increase, where you gain incomes on 5 years by an increase 21% compared to 16% over 25 years. The key point to note here is that if you look at the bottom bar chart, that is the additional years gained. So there's 2 points. You're firstly gaining more income, and secondly, you're gaining more years. So on a 5-year basis, using protected equity, you'd gain an additional 1.25 years. And on a 20-year basis, you'd gain an extra almost 6 years with more income. So that certainly is very powerful and something worth considering or taking a closer look when 25% extra years gained on average certainly is very valuable. How we do this, and my colleague Chris will speak to this in greater detail, but we believe in investing and fit for the cycle and making sure that portfolios are built fit for purpose for the right cycle. So for instance, during an expansionary phase, the least risk portfolio would look very different during a recession phase. So we want to make sure that portfolios are fit for purpose and, playing on and extending on the theme of multifarious and not nefarious. They must be fit for purpose and relevant. We know that South Africa is very much a value-orientated market, but depending on what your investment philosophy or belief is, we're looking at what expected returns are for equities. And if you're a value investor, we know that high multiples typically translate into lower expected returns. And if you're a growth investor, you'd expect these high PE stocks to continue outperforming and growing, as we've seen over the last 5 years, where growth has significantly outperformed value. So if you're of the value belief or philosophy, you would think you'd be worried that assets are maybe too expensive or at elevated valuations, and now's not the time to invest in equities. But the risk gets the opportunity cost of not benefiting from the returns or the equity returns harvested from equities. So what we would suggest is, if the expectation is for high expected returns, and the cost of protection is low, so cost of protection is cheap, have lots of growth assets and some protection. Why some protection? Because it's cheap and it's worth having the insurance. If you're expecting low equity returns and cost of protection is cheap, then have exposure to growth assets and lots of protection, because low expected returns could translate into more volatility or capital loss. And if markets have if you have the expectation of high equity returns and cost of protection is cheap, we would suggest having a combination of growth assets and defensive assets. If cost of protection is expensive. And if you are of the view that expected returns are going to be low and cost of protection is expensive, then steer clear of equities and rather focus on cash or other defensive assets. So that's just a nutshell of how we're navigating our portfolios in terms of trying to solve for longevity risk by having higher exposures to equities or exposure to equities for longer without compromising on capital loss. So the key points from my side is consider investing over the business cycle and the use of protection, and making sure that you get the benefit of equity returns in providing you that strong hedge against inflation and to extend your years of potential income on both a pre-retirement basis as well as on a post-retirement basis. And with that, I'll conclude and hand over to my colleague Chris, who'll unpack the opportunities of traditional LDI strategies. Thank you.
Thank you, Naveen. The purpose of this session is to try to discuss and tie together what Naveen was talking about and how you can enhance an LDI strategy to compensate. So I think if you look at the data that Naveen presented, you see a potential risk in pension fund strategies and broader institutional strategies where you find yourself in a situation where you're quite well funded today, but in 5 to 10 years, as the longevity risk starts to materialize, you might find yourself in a unfortunate situation where this funding situation has deteriorated meaningfully. So what we've done in this presentation is try to set a framework for how you can try to compensate for that in your asset strategy starting today to prevent these issues from materializing in the future. Now, graphically, what that means is we want to look at protected growth strategies in partnership with an LDI mandate or lower risk solution, and how do you incorporate it in such a way that it doesn't materially negatively impact your potential on your surplus or funding ratio in the long term. And this is the framework we sort of came up with, and the idea being that you can allocate a greater proportion of assets to high growth or protected growth based strategies in the event that you've got an element of certainty around your outcomes. Now, certainty in inverted commas as I'll get into in the next couple of slides. But the idea is the more certain you are, the higher proportion you can add to growth, and the less certain you are, the more uncertain the world is around you, the lower proportion to growth, and as a consequence, the higher proportion to a traditional LDI mandate. Now, in order to do something like this, you do need a set of things or capabilities around you to harness this flexibility. Now, naturally, in order to run something like this, you need suitable governance, risk, ops, etc. That goes without saying, but you also need a sophisticated quantitative capability and a strong investment process to highlight the appropriate mix that needs to go into these things in various scenarios, and over and above that, to be able to adequately measure the risk associated not just with the two component building blocks, but over and above that in the aggregate portfolio. So how do these two things work together in the long run? I think if you can crack those three broad categories of capability, you end up with quite a powerful tool to mitigate some of the risks Navin was talking to in his presentation. A simple example of that is what we've put up here as a protected equity strategy. So what we've done there is shown the volatility associated with let's call it the market, and then a very basic hedging algorithm that we've put in place over that equity strategy in order to mitigate the volatility. So back to what I was saying earlier, to try to get a more certain outcome than you would traditionally have. The idea being that you're looking at your capture ratio. So you want to disproportionately participate in the upside market relative to the downside market, trying to get a capture ratio in excess of 100. And I think you can see that quite nicely on this chart, where in the events of market downturns and drawdowns, the protected equity strategy looks to reduce volatility, and whilst maintaining meaningfully positive upside when the chart's rising. An easier way to depict this is if we focus and drill down onto the drawdown characteristics, and I think this is quite powerful in the sense that that orange line showing those dips is partially the reason that we are hesitant originally to add pure growth assets to an LDI mandate, because those material drawdowns can have quite a negative impact on long-term funding levels. However, if you can constrain that and mitigate it, you get the certainty around your solution that allows you to allocate these asset classes into your traditional LDI mandates. So what does this all mean? And I think I'd like to close with a very simple example of how this type of thinking can be quite useful for an institutional investor. We all know in SA at the moment we have quite low cash rates. Ideally, we would like to participate in the longer end of the curve and benefit from the term structure of interest rates and generate a higher running yield. The challenge, of course, being that those longer dated bonds come with higher duration and by extension higher volatility of your asset base versus whatever your liability base is in this context. So what we say is you can potentially address this by buying the long end bonds, but putting in place the appropriate option structure or combination of various derivatives such that you end up with the payoff profile on the right hand side of the screen. So you benefit from this higher running yield, and you've constrained the volatility such that your worst case and best case scenarios become known, and you've almost constrained that volatility around the investment or the strategy for yourself, enabling you to purchase these assets under the existing risk budget. So I'd like to end there, and thank you for your time. What I'm going to do now is hand over to Rudiger Klein for his panel discussion, which will start briefly.